15 reasons why you should exit a stock. First is follow your plan. Whatever your plan tells you before you enter into the trade is what you should follow. Next is follow a CEO. If he's selling his stock, you should do the same. Of course, he's probably not selling all of his shares, so you could leg out 10, 20% depending on what other things you see. But if he's scaling out, he's taking some profits, so should you. Open Insider, free information, top tab, insider sales for the last month. Or you could type in your ticker, Facebook, and you can see for the last 5 months, Mark Zuckerberg's been selling off hundreds of millions of dollars of Facebook stock. I don't know if this is all of his shares, but he's definitely scaling out. So should you. Another way to verify is when the CEO is selling his shares, take the ticker like CRSR, go to Stock Target Advisor, and see what their valuation for the stock is. If the price is almost $45 and they think the price is fair market valued around $32, take some profits. This should be another reason to exit the trade. When you're really happy because your stock's been going up, time to take some profits. Exit the trade. If you find yourself being complacent and the market going sideways and your stock's not making any profits for a while, time to exit some of the trade. A farmer plants seed. Once that corn comes up, he doesn't sit there and say, oh, let me wait till next year and see if those will just dump seed back into the earth and replant me another harvest. No, he's happy. He's delighted with what he sees. He takes the harvest in and he makes gains on that. If he lets that harvest sit out in that field, it will go to waste. It will be ruined. And next year he'll lose everything that he built. So if you're happy and you know it, take some profits. Just like the farmer has seasons, the stock market has seasons. We have the Christmas rally. Starting in October going to January, there tends to be a Christmas rally. Sometimes this is 25%, sometimes 15%, sometimes 10%. On average, this is from 2002 to 2008, where we know we had the downfall. And during that time, the Christmas rally was a dud. Now, that's not to say that the stock market's always going to go up for a Christmas rally when you have an uptrend, nor that it's always going to go down when you have a downtrend. Seemingly, this was a downtrend, but we had an up rally. Once rallies end, guess what happens? There's going to be a phase of time where either it's going to pull back a little bit, maybe 10%, or it might change the trend. With this downtrend, we came into this W pattern at the bottom, and you can see that markets changed after that and started going back up. So that's one thing to always think about when you're exiting a trade. Is the rally of the season over? Another one is biblical measures. The Bible has a lot of stories, and in some of the stories, it talks about 30%, 60%, 100%, but it never says like 10,000%. And a lot of times we know this in business. If you can get 100% gain on a product or 200% gain on a product, you're doing fantastic. So when people's desire is to have 10,000% gains, it's a little bit unrealistic. So when you see 30, 60, 100% gains, take some profits, exit some of the trade. Now, just like percentages, you have whole numbers. You have 50, 100, 200, 500, 1,000. When you see numbers like this in your stock, take some profit, exit the trade. Bitcoin went to 40,000. Pulled off. Dow Jones went to 30,000, pulled off. Hold numbers. I dare you to look and see how many stocks you can find went up to $100, then pulled back. Went up to $200, then pulled back. Hold numbers is a good place to take some profits. Here's Amazon, went up to $2,000 and then it pulled back over 30%. Went up to $700 and then pulled back 30%. Went to $400, then pulled back 30%. $250, pulled back 30%. $150, pulled back 30%. We see that happen over and over again. Those whole round numbers, people take profits, let it sell off, pick it back up at another whole number. Now the flip side is true. So now if you see that pullback happen at a whole number, it goes down 30 to 50%. You enter into the trade. Where do you take the profits? Back to the highs. Exit the trade making 30% profit in just a couple months. Exit the trade back at these old highs making 40% profit in just 6 months. Back to old highs is great because what is it? It's a double top. There's some resistance there. We've already seen some people sell off, and so we think that we'll get the same reaction. Based on results of history, people will sell again. Like this example on Amazon, it went back up to the old highs of 42%, then sold off again. Went back to those old highs, then sold off again. Old highs is a good place to take targets. Now, when you understand what you just did, you made a range box. Another great place to take targets. So we can see price consolidate in here, making a sideways channel. Every time it hits this resistance, it goes down. Every time it hits this support, it goes up. We can duplicate that range box up and take more profits here. Then duplicate that range box up again and take more profits here. A lot of people ask me how I come up with range boxes, and it's kind of simple based off some common patterns. One, cup and handle pattern. Cup and handle basically takes a high, comes down to the low, comes back to the high, take profits. Then it pulls back. That's why we took profits, giving you a handle. The way the system works is you enter into the trade on the handle, duplicate the range from the highs and lows, giving you this move here to exit the trade. Another reason I use range boxes is the pattern head and shoulders. It says based off of this whole head and shoulders pattern that you take the range. Once price breaks below, you duplicate that range down and you take profits, a reason to exit the trade. Another reason we use range boxes is because this flag pattern here, what happens is the run up, which is an impulse wave, then the consolidation. If you duplicate that range box over here, it should be the exact number. Whatever it was in the first part, 500 pips, would be 500 pips to take some profits, exit the trade. Next, a lot of you probably learned about the Fibonacci retracement. It comes up into a high, and as we've talked about today, it then pulls back to a Fibonacci level being 38, sometimes 50, sometimes even deep pullback, 61% off of the highs. But did you know Fibonacci had an extension, which basically takes from the original move, range box, breaks out of that original move and goes up, which is a range box. Just like the flag pattern, just like the head and shoulders, just like the cup and handle, all of these things are the same. So the range box basically is the cup and handle, the head and shoulders, the flag pattern, Fibonacci extension. I just simplify it, make it easy. And that's why we should be using patterns as an exit. When you see a pattern, you should be using it as an extra. Did this pattern complete? And is it going to change the trend? A next way, and a lot of people use this, is a 200 moving average. As long as price is over the 200 moving average, it's bullish. So sticking with Amazon, I don't absolutely love this because price came all the way up here to 2100, went under the moving average, and then you basically lost about 15% of your shares at a lower value. Then turns right back around and goes up again. So if you're using moving average, just realize that it's not getting you out at the tippy top because you're going to have that pullback down to the moving average for you to make sure that you have the signal. Some people will add a 50 moving average, calling it the golden crossover. So it would have got you in here. It would have saved you from losing money here, and you would have been able to catch that whole run up. But you can see with sideways movements, there still is some drama. Reasons to exit the trade: when you're looking at trailing stops, the standard setup on this is 3.5. In all honesty, it does a pretty good job. You had a pullback here, but it didn't get you out. Pullback here, didn't get you out. Here was the signal to enter. Here was the signal to exit. Still made you almost 65%. This ATR trailing stop is a pretty basic system to enter and exit. I like this way better than moving averages. Next, I call LRC, which is a linear regression channel. It prints the channel on there for you. It shows you the bottom, where to enter into the trade, and it shows you the top, where to exit the trade. Great little system. I like this because it gets you at this extreme high, unlike the moving average where price would have to fall down to get out of the trade, losing you profit. Another thing very similar to the LRC is the standard deviation channel. You can set this at 2, or you can modify it. You can go 2.5, you can go 3, and also with the LRC, you can make that 100, you can make it 115, 110, 120. You can increase it to give you more room for that extreme outside port to buy. And on this chart, the standard deviation is giving you a wider look. But on other charts, the standard deviation dotted line is giving you a tighter look. Here's the great thing about using two different, very similar type systems is you enter twice and you exit twice. Sometimes it prints very close together. But these are very good indicators to show you where to take profit. Here's Roku. Should you buy here or should you be thinking about exiting? That's right, take some profits. Next reason to take some profits is the Elliott Wave. So like we talked about before, you have wave 1, which is a flagpole. Then you'll have some kind of retracement back, either 38% to 61, 78, it doesn't matter, but you'll have a pullback. Then you go into the Fibonacci extension. Big run up, goes into resistance. You have another pullback, usually smaller than the first pullback. Last wave completion, leg 5. After that, you have an ABCD pattern, which is usually comes back into this support level, which makes up a head and shoulders, giving you that retracement back up, and then the continuation down lower, head and shoulders pattern. Trading stocks is very easy once you start to see how this all fits together. Leg 1, run up. Leg 2, pullback. Leg 3 is longer than leg 1. Leg 4, pullbacks, usually pretty small. Goes into leg 5, which is right up against this channel line. This is a good reason to exit the trade. There's literally hundreds of good reasons to exit trades. Based on what kind of increase you're trying to accomplish is going to depend on what you're looking for. Out of these systems, what looks best to you? What you understand the easiest? What you like to see in your trading system to help keep some of those profits is going to be based on how you view things. What works best for me doesn't necessarily mean it's going to work best for you, but you have to have at least 2 or 3 indicators that show, hey, I need to be taking some profits. Corn doesn't replant itself. It needs a manager to make the system work. You're that money manager. Put your money in the right thing. Don't be in love with the stock. The stock is not what made you the money. You putting it into stocks and allowing that investment to grow was what made you money. If Elon Musk didn't put money in Tesla where it's valued right now, that tells me it's not worth it. What are your stocks telling you right now? Is it worth it to put money in right where the price is at? And if you say no, then maybe you should be considering taking off some profit. If you say yes and you have hope within you that it should go up and make more profit, then that seems like it'd be a good time to invest. Understand how you feel. You're smarter than you think. Ring that bell.